what if I told you that every time you see a breaking news alert about a surprise Federal Reserve rate hike driving up inflation, that the math behind that claim is, well, it's basically completely fundamentally broken?
Yeah, totally broken, which is wild to think about.
Right. I mean, seriously, think about all those times you've watched a financial news anchor, point to a sudden dip in the market or a spike in consumer prices, and they just confidently blame it on some unexpected move by the central bank.
All happens every day.
Exactly. And we just consume that as absolute engineered fact. But when you actually peel back the layers of how macroeconomists calculate cause and effect in the massive, chaotic web of the global economy, you find this landscape that is incredibly murky.
Murky is definitely the word for it. It's really hard.
Right. Because isolating exactly how much a specific surprise drives the economy versus just being, I don't know, random background noise is actually one of the hardest mathematical problems out there.
It really is.
So welcome to today's deep dive. Your mission today is to completely rethink everything you thought you knew about cause and effect in the macroeconomy.
It's a massive foundational question, honestly. And the uncomfortable truth here is that for decades, the standard way we answered it relied on mathematical models that were just incredibly fragile.
And that is exactly what we are digging into today. We're looking at a single, highly influential source. It's a 2021 National Bureau of Economic Research working paper by macroeconomists Mikkel Plagborg-Moller and Christian K. Wolf.
A fantastic paper.
Yeah, and it's titled Instrumental Variable Identification of Dynamic Variance Decompositions, which I know that sounds incredibly dense.
It's a mouthful.
Total alphabet soup. But this paper is a complete paradigm shift. It basically proves that a lot of what we think we know about how, economic shocks drive the economy might be based on deeply flawed econometric models.
Okay.
And when you actually correct the math, some massive assumptions like unpredictable Fed policies being this huge major driver of inflation, they just completely fall apart. Okay, let's unpack this. We have to start with the core problem macroeconomists face, which is, at its start, a measurement problem.
Precisely. Because, think about it. If you are a chemist, your job is relatively straightforward in terms of measurement.
Sure.
You put two chemicals in a sterile test tube. You completely isolate them from the rest of the universe, and you observe the exact reaction.
Right, completely controlled.
Right. But you absolutely cannot put the U.S. economy in a test tube.
Obviously.
You cannot isolate a monetary policy shock from a sudden technology boom, or a shift in consumer savings habits, or like a global supply chain bottleneck.
Because they're all happening at the exact same time.
Exactly. They're all happening simultaneously, overlapping and interfering with each other. So to isolate the effect of just one thing, say a surprise change in interest rates, economists use what we call external instruments or proxy variables.
Because you can't measure the shock directly, you have to measure its shadow.
I love that. That is a very apt way to look at it. You are measuring the shadow or, the footprint left by the shock.
Okay, so give me an example.
Well, the authors heavily discuss this famous approach developed by economists Gertler and Karate. If you want to measure a pure, uncontaminated monetary policy shock, you can't just look at the overall interest rate over a month.
Too much noise.
Way too much else going on. So what they did was look at high-frequency changes in asset prices, specifically federal funds futures, in this remarkably narrow 30-minute window right around a Federal Open Market Committee announcement.
Wow, just 30 minutes.
Just 30 minutes. And the logic is actually pretty elegant. The market is so efficient that any sudden jump in those prices within that tiny specific 30-minute window must be the direct result of the Fed's surprise announcement.
Right.
And not some other random economic event happening that day.
Okay, so it's like trying to measure how much a massive storm flooded a city, but your only measuring tool is a single leaky bucket that you left out in the rain for exactly 30 minutes.
Yes, that's exactly it.
You are definitely getting some undeniable data about the rain, but it is heavily contaminated. Like, it's missing all the rain that fell outside your 30-minute bucket window, and maybe some water leaked out the bottom.
Right. And in econometric terms, we call that exact phenomenon measurement error.
Okay.
These proxies, like the 30-minute high-frequency window, they're inherently noisy. They completely miss any monetary shocks that might leak out into the market before or after that specific time frame. Furthermore, The financial data itself is full of what we call market microstructure noise.
Right, which isn't actual economic substance at all. It's the digital static of the market.
Exactly, digital static.
Like high-frequency trading algorithms glitching out or an uninformed institutional trader executing a massive block trade just to rebalance a portfolio.
Yeah, or algorithms just reading a keyword in a press release and reacting blindly.
Exactly. It creates price movements that have absolutely nothing to do with the actual underlying economic shift.
Exactly. The proxy is capturing all of that static along with the actual signal.
Which brings me to my major pushback here. If macroeconomists know their bucket is leaky, if they know this proxy data is packed with algorithmic static and completely misses half the actual event, are they really just plugging it into formulas and hoping for the best?
Oh.
Because that seems incredibly reckless for people whose research advises the entire global financial system.
You are hitting on the exact historical vulnerability that Plagborg-Moller and Wolff are addressing in this paper. For a long time, the standard practice in empirical macroeconomics was to essentially ignore the leak.
Wait, really? Just ignore it?
Just ignore it.
Yeah.
Researchers would take that noisy proxy and just treat it mathematically as if it were the literal perfect shock itself.
Wow.
They assumed zero measurement error. But when you do that, when you feed a flawed input into the model and pretend it's perfect, you introduce this fatal flaw called attenuation bias.
Okay, let's make sure we really understand the mechanism there. How does assuming the bucket is perfect ruin the math?
Think about what the mathematical model is trying to do. It is trying to correlate the size of the shock with the size of the economic outcome, like inflation, for instance.
Okay.
If you treat a noisy, incomplete proxy as a perfect measurement, the math gets incredibly confused.
How so?
Well, it looks out at the broader economy and sees a ton of massive movement. Inflation spiking, output dropping, that your tiny, leaky proxy didn't capture.
I see.
Since the math firmly believes your proxy is the entirety of the shock, it concludes, well, the shock was tiny, but the economy moved a lot. Therefore, this shock must not be very important in the grand scheme of things.
Oh, wow.
It drastically understates the true underlying importance of the variable. You end up with a severe downward bias.
It aggressively waters down the truth. The model blames the noise instead of the event.
Precisely. And so, if treating their proxy as a perfect measurement is mathematically flawed and basically guarantees this attenuation bias, we need a completely new framework.
Right.
We cannot simply guess what the measurement error is. The authors realize that we have to basically mathematically embrace the unknown.
But if we throw out the old way of pretending the proxy is perfect, what actually replaces it? What are Plagborg-Moller and Wolff actually measuring in this paper?
So they utilize a framework called the SVMA-IV model.
Okay.
That stands for Structural Vector Moving Average with External Instrumental Variables.
Okay, the acronyms are dense, but the core thing they're trying to calculate with this model is highly intuitive, I think. It is a metric called the forecast variance ratio, or FVR.
Right. Let's ground the FVR in reality. Imagine you are an econometrician whose sole job is to forecast industrial output or inflation over the next 12 months.
Sounds stressful.
It is. Naturally, you have a certain amount of uncertainty, a variance, a margin of error in your forecast.
Okay.
The forecast variance ratio measures exactly how much your ability to forecast that variable would improve if you were magically handed a crystal ball that showed you the exact, true, unnoisy future path of one specific shock, like Fed policy.
Oh, that's really cool.
Right. If the FVR is high, say 80%, it means that specific shock is hugely important. Knowing it eliminates 80% of your forecasting error.
Got it.
But if it's low, it means that even if you perfectly knew what the Fed was going to do, you still wouldn't be able to predict inflation because the shock just doesn't matter that much.
But here's the catch. Because of the leaky bucket, because of the market static and all that measurement error we just talked about, we cannot calculate that exact FVR number. We don't have the crystal ball.
Exactly, we don't.
So instead of giving us one single, probably wrong number, the authors create what they call an identified set. It is a range, a sharp lower bound and a sharp upper bound of the truth.
Exactly. And both bounds are calculated using entirely different mathematical logic, which is the genius part.
How so?
Well, the lower bound is essentially derived from the old way of doing things. You calculate it by pretending the proxy actually has zero measurement error.
Right, the leaky bucket.
You treat that 30-minute financial market window as if it captures the absolute entirety of the Fed's impact. As we just discussed with attenuation bias, this gives you the absolute minimum possible importance of the shock. It relies entirely on the raw statistical strength of your instrument.
Hold on, I need to jump in here on behalf of the listener.
Sure.
If we are just guessing an upper and a lower limit of the truth, aren't economists just throwing their hands up like, oh, the impact of the Fed on inflation is somewhere between 5% and 50%. Good luck figuring it out. How is providing a massive range actually useful to a policymaker or a central banker?
That is a very fair critique of ranges in general, absolutely.
Yeah.
But it misunderstands what makes this specific paper so groundbreaking. These are not arbitrary guesses. These bounds are mathematically sharp.
Okay, here's where it gets really interesting. Sharp, in this context, means they exhaust absolutely all the information contained in the data, right? You literally cannot narrow the range any further without imposing your own subjective assumptions or basically making stuff up. The math is squeezing every single drop of truth out of the numbers.
Exactly. And that is why the upper bound is so fascinating. The upper bound approaches the problem from the complete opposite direction of the lower bound.
Okay.
Instead of looking at the leaky proxy, it looks at the macroeconomic data itself, the actual inflation numbers, the actual industrial output, the actual interest rates.
Yeah.
You calculate the upper bound by asking the math to assume that these observable, real-world variables perfectly explain the hidden, unmeasured shock.
Oh, I see. It is reverse engineering the cause from the effect.
Yes, exactly.
You are essentially asking the model, given all the massive ripples we are currently measuring in the pond, what is the absolute largest possible rock that could have been thrown in without contradicting the ripples we see?
Right. It relies completely on the informativeness of the data
Right.
rather than the strength of the proxy.
Yes. And what is brilliant is how you can manipulate that upper bound. Because adding more variables into the model actually tightens the trap around the truth.
It really does.
Like if you build a model and only feed it inflation data, your upper bound for a Fed shock might be 100%. The math says, hey, we only have one ripple to look at. Maybe this Fed shock caused literally all the inflation. We simply don't have enough data to prove otherwise.
Right.
But the moment you add interest rates and output into the model, the upper bound violently shrinks. Because the math suddenly sees that a massive Fed shock doesn't just move inflation. It moves interest rates in a very specific, mechanical way.
Exactly.
If the hidden shock was truly massive enough to cause 100% of the inflation, it would have moved interest rates in a way that we simply do not see in the real-world data. The data contradicts the massive rock, so the upper bound drops. The more macro variables you feed the model, the tighter the mathematical trap gets.
But to truly grasp why calculating this upper bound using SVMA-IV is such a monumental shift, we have to look at the fatal flaw of the traditional models that ruled macroeconomics for decades.
Okay, lay it on me.
I'm talking about structural vector autoregression, or SVAR models.
SVR models, the old workhorse of the industry, why are they getting the upper bound wrong?
Well, SVAR models rely on a massive structural mathematical assumption called invertibility.
Invertibility.
Yeah, invertibility is the strict assumption that an underlying economic shock can be perfectly reconstructed or inverted using only current and past data.
Ah, past data.
Right. The model fundamentally assumes that if you just look at what happened in the economy yesterday and what is happening right this second, you have all the information you need to perfectly identify the shock that just hit the system.
But in the real modern economy, that assumption completely falls apart.
It completely falls apart.
And it fails because of something called forward guidance, which generates what economists call news shocks.
Right.
This is crucial historical context for you listening. Back in the day, the Federal Reserve used to be incredibly secretive.
Very true.
They would just change rates and surprise everyone. But starting in the 1990s and 2000s, central banks shifted their strategy. They started telegraphing their moves. They started holding press conferences saying, hey, based on our projections, we're planning to raise interest rates 6 months from now.
And when they do that, the markets absolutely do not wait 6 months to react.
Never.
People and institutions react today to things they know are going to happen tomorrow. They price in the future immediately.
Which totally destroys the math of invertibility.
Completely.
It is exactly like trying to guess the twist ending of a movie by only watching the first half.
Oh, I'd like that.
You are sitting there in the theater looking at the characters which represent the economic agents, the businesses, the consumers, and they are doing things that make absolutely no sense based on the plot so far. The protagonist is suddenly buying a lot of weapons or hiding money.
Right, it seems crazy.
You, the audience member or, the econometrician looking at past data, are totally confused. But the characters are acting that way because they possess foresight about the script that you don't have.
Yes.
If your mathematical model only uses past and current data, if it relies on invertibility, it is going to output complete garbage because it cannot account for anticipation.
That is a phenomenal analogy. It captures the exact mechanism of the failure. The model's information set is hopelessly misaligned with the actual information set of the people living in the economy.
Right.
And this is exactly where Plagborg-Moller and Wolf introduce a mathematical breakthrough. They utilize a much weaker but vastly more realistic assumption called recoverability.
Recoverability. How does that fix the movie script problem?
Recoverability essentially argues that the true shock can be spanned or reconstructed by looking at past, present, and future data.
Oh, future data.
Yes. By letting the math look ahead at the future realizations of the macroeconomic variables, the SVMA-IV model effectively realigns the information set. It gives the econometrician the exact same foresight that the economic agents had.
It allows the math to do a sort of time travel.
Basically.
It lets the model peak at the movie's ending, and then suddenly the math realizes, that is exactly why the consumers in the bond markets were acting so strange in the first half. It fixes the forward guidance problem completely.
Yes, mathematical time travel is a great way to visualize it, but the authors don't just ask you to blindly accept that invertibility is broken and recoverability is better.
They prove it.
They do. They provide a concrete mathematical proof, a pretest to definitively show when the old SVAR models are failing.
Right, the Granger causality pretest.
Exactly. The mechanism here is quite elegant. You take the residual of your instrument.
The residual.
Think of the residual as the unexplained leftover noise in your proxy, the piece of the high-frequency asset jump that simply cannot be explained by any past macroeconomic data.
Yeah.
You isolate that leftover noise, and you run a test to see if it can predict future macroeconomic variables. If your unexplained proxy noise today can successfully predict what the economy does tomorrow, it definitively proves that the economic agents knew something today that wasn't showing up in the current macro data.
The characters knew the ending of the movie.
Precisely. If the residual predicts the future, it definitively proves the shock is non-invertible. The old models are officially broken, and you must use the bounded SVMA-IV approach.
Which brings us out of the realm of abstract math and into high-stakes reality. What happens when we take this new, robust, time-traveling math and apply it to one of the most fiercely debated questions in modern finance? How much does U.S. monetary policy actually drive the broader economy?
Well, the authors put their method to the test using post-1990 U.S. economic data. They utilized that exact Gertler and Karate proxy we mentioned earlier, the 30-minute high-frequency asset price changes.
Right.
And the very first thing they did before running the main model was run that Granger causality pretest.
And the results of the pretest. Did the old models survive?
Not at all. The pretest showed that the data is consistent with substantial non-invertibility.
Wow.
As we suspected, the massive rise in Fed forward guidance over the last 3 decades meant that the financial markets were constantly reacting to future news. This proved, mathematically, that all the traditional SVAR models that assumed invertibility were definitively getting it wrong. They were heavily biased.
So having proved the old math is broken, they unleash the new model. They calculate the sharp lower and upper bounds for the forecast variance ratios across different time horizons. Let's trace the actual shockwave of a Fed surprise through the economy based on their findings, because the results are honestly staggering.
Let's follow the data. They looked at 4 distinct variables. Naturally, you start at the epicenter, the federal funds rate itself.
Makes sense.
As you would expect, the monetary shock drives a significant amount of the variance in the federal funds rate initially. The upper bound sits around 60% in the first few months.
Okay.
But what is striking is how quickly that influence dissipates over a 24-month horizon.
Okay, well, that makes sense. The Fed controls its own rate. But does the shockwave hit Main Street? Does it impact actual economic output? They looked at industrial production growth next, right?
Here's where the narrative starts to shift. For industrial production, the upper bound never crosses 31% at any time horizon.
Just 31%.
Yes. This means that even if we are incredibly generous and assume the absolute maximum possible mathematical impact of these unpredictable Fed shocks, they account for less than a third of the variance in industrial production.
Okay, so a fairly muted impact on the physical economy. What about Wall Street and the credit markets? The third variable they tracked was the excess bond premium, which is essentially a measure of corporate credit spreads and financial stress.
This variable shows a deleft reaction. It peaks at around a 30% upper bound, but only after 12 to 15 months have passed.
Okay, so a slow burn.
Right. There's a slow-moving ripple through the credit markets, but again, we hit a very hard mathematical ceiling on how much the surprise shock actually matters.
And finally, the big kahuna, the variable that dominates absolutely every news cycle. CPI growth, inflation. When I traced this specific chart in the paper, I was genuinely floored.
It is essentially a flat line.
Flatline.
Yeah.
The chart is hovering near zero. The 90% confidence interval mathematically and strictly rules out that these erratic monetary policy shocks account for more than 8% of the variance in inflation at any time horizon. 8%.
It is an incredibly striking empirical finding. Despite the massive, almost obsessive amount of attention paid to every single surprise move or unexpected phrasing the Fed makes, the mathematical reality is totally different.
It really is.
When you properly account for measurement error and when you allow the math to see the anticipation through recoverability, these erratic, unpredictable shocks are practically irrelevant for driving aggregate inflation dynamics.
Now, I have to ask, is this just an anomaly specifically related to the Federal Reserve and U.S. data? Did the authors test this bounding methodology on anything else?
They did, briefly but effectively. They wanted to see if this non-invertibility problem plagued other areas of macroeconomics.
Okay.
So they applied the exact same SVMA-IV methodology to global oil supply news shocks. They specifically looked at how the market reacts to OPEC announcements, utilizing a different proxy developed by an economist named Kenzig.
And what did they find?
They found the exact same underlying mathematical failure.
You're kidding?
Nope. Oil news shocks are highly non-invertible. Think about it. When OPEC holds a press conference and announces a production cut for next quarter, the global oil markets react instantaneously, long before a single barrel of oil actually stops flowing from the well.
Right, of course.
Applying conventional backward-looking models to OPEC announcements leads to spurious, biased conclusions, just like it did with the Fed. The new math corrects it, proving the bounds are a universal tool.
So what does this all mean? We have gone through the leaky buckets, the attenuation bias, the bounded sets, and the time-traveling math. When we step back from the equations, what is the ultimate takeaway here?
The most profound conclusion of this source material, the real paradigm shift, is this. To the extent that massive macroeconomic forces like inflation are driven by monetary policy, it is strictly because of the systematic, predictable part of that policy.
The system itself.
Exactly. It is the long-term rules of the game. It is the steady, communicated framework. It is absolutely not the erratic, unpredictable, surprise policy shocks. The math definitively proves those sudden shocks have a very low, hard ceiling of actual impact.
And this is exactly why you, the listener, should care deeply about this deep dive. We live in a society characterized by absolute information overload. We are practically trained to obsess over breaking news, to panic over sudden shocks, unexpected announcements, and the red banners flashing across financial news networks.
We really are.
But this advanced econometrics paper proves that the shocks often matter far, far less than the underlying system. The noise is usually just noise.
It serves as a vital mathematical reminder to maintain your critical thinking. When you hear a loud narrative assigning massive blame or massive credit to a sudden singular event, you have to pause and ask, is that narrative actually supported by the bounds of the data, or is someone just misreading a noisy proxy through a completely broken model?
Which leaves me with a final thought for you to chew on as we wrap up. If the most rigorous, time-traveling, invertibility robust math proves that sudden, unpredictable shocks, whether it's Fed surprises or OPEC announcements, have a strictly limited ceiling on how much they actually disrupt the macro system, why does our 24-hour financial news cycle spend 99% of its time covering the shocks instead of the system? What if you applied this exact same bounding concept to your own life? Think about all the sudden, noisy, unexpected crises you worry about day to day. Are those unpredictable shocks actually driving your personal outcomes, your long-term success or failure? Or just like the sprawling global economy, is it actually your systematic day-to-day predictable habits that are doing all the real work? Something to think about.